Good Friday morning. Welcome to Inside India. I'm Dan Murphy. Here are your headlines. First today, India doubles down on its relationship with Russia in the face of U.S. tariffs. Foreign Minister S. Jaishankar getting FaceTime with Russia's leader Vladimir Putin in Moscow as the two countries look to expand trade ties. Plus, India finding some support in unlikely corners as China slams U.S. tariffs on the South Asian country in a further warming of ties. And India also cracking down on fantasy gaming, passing a bill to ban money-based online games in a plot twist that has caught some investors off guard and is raising concerns about a wider jolt. It is Friday morning here on CNBC. Good morning. Welcome to the program. Let's take a deep dive into exactly what's happening across the Asia markets right here, right now, as we look to close out what has been quite a busy week. And indeed, it is perhaps about to get a whole lot busier as we track into what could be one of the most consequential moments of the quarter. And in particular, as we look ahead to Chair Powell's speech at Jackson Hole. The major markets across the region looking mostly mixed at the moment. You can see with an upside bias here, the Nikkei 225 just holding above the flatline there. But stocks in Australia and New Zealand have been pulling lower alongside the TAIEX, which is down by 0.2%. As I mentioned, all eyes are on Wyoming tonight, where the Fed Chair Jay Powell takes the stage at the annual Jackson Hole Symposium. Markets, of course, watching closely for any signals on the Fed's next move and whether or not a September rate cut is on the table. Expectations are scaling back for a cut in September, with Fed funds futures now indicating about a 75% chance for a 25 basis point cut. The Kansas City Fed President Jeffrey Schmidt told CNBC he's still in watch and wait mode.
We've got a lot of data to harvest between now and September, and I think something will emerge where I think we'll start to see a little bit more definitive move one way or the other.
So at this point, are you a person who could go either way in September, or do you have your mind made up, or
it's
leaning a certain way?
No, I'm like most everybody. My mind's not made up until we've got Joe Gruber and a team that actually continues to synthesize what's going on. We'll get around tables and we'll collaborate and we'll figure it out. But yeah, I think there's a lot to be said between now and September.
Still too early to say. Okay, meanwhile, on the trade front, the EU and the US finally putting pen to paper on the details of their deal. The joint statement saying the 15% US tariff will apply to most European imports. The US will also scrap its current 27.5% tariff on autos and auto parts once the EU cuts US tariffs as promised. Meantime, India's Foreign Minister S. Jaishankar met Russia's President Vladimir Putin at the Kremlin yesterday. It comes as India faces one of the highest U.S. tariffs as a penalty for buying oil from Moscow. Jaishankar urged Russian companies to engage intensively with India. Before meeting Putin, the Indian Foreign Minister also met his Russian counterpart. After the bilat, Lavrov saying Moscow is interested in additional joint energy projects with New Delhi. And China's ambassador to India also coming out in support of New Delhi against those U.S. tariffs, saying the U.S. is using tariffs as a bargaining chip to demand exorbitant prices from countries. Listen.
The United States has imposed tariffs of up to 50% on India and even threatened for more. China firmly opposes it. In the face of such acts, silence or compromise only emboldens the bully. China will firmly stand with India to uphold the multilateral trading system with the World Trade Organization at its core.
So take that, Donald Trump. Meanwhile, Indian markets coming online in around 40 minutes' time. Let's get a live look at how futures are indicating right now. You can see the market is expected to open a little softer today, basically in line with what we're seeing playing out across the wider APAC markets here, down by 0.22% on GIFT Nifty futures right now. And as we mentioned in the headlines, the market has been talking about India's latest online gaming bill as well this week. The bill bans any online games played with real money. It caught many investors off guard in the sector that's backed of course, by private players like PeakXV and Tiger Global. Take a look at shares of Nazara Technologies, for example. This is the only listed player in the space, down over 14% so far this week. We're going to talk more about this later on in the program and bring you insights on what it means for those institutional investors and, of course, the future of the sector as well. The Indian market regulator continuing to try to cool the country's booming derivatives trade as well. Among the ideas on the table is longer tenure contracts and even suitability rules to limit small investors' exposure to risky bets. SEBI saying over 90% of retail traders lose money in the options market. The regulator has already hiked lot sizes and cut contract expiries to slow that frenzy. Shares of the Bombay Stock Exchange, that gets over half of its revenues from derivatives trade, slipping in yesterday's session. Well, let's unpack this and so much more with Hartmut Issel. He's the head of APAC Equities and Credit at UBS Global Wealth Management. Joining me live this morning. Hartmut, a warm welcome. Great to have you on the program. I want to kick off with what we're seeing coming out of SEBI because, of course, this is having a really significant impact on the space here. Cracking down on derivatives trading, what do you think this means for India's hot derivatives market? Certainly a growing area of investor interest over the last couple of years.
Yeah, it's certainly not unusual, and it's not the first time when we see SEBI taking some action, and I think it is actually a good approach. Right? We've seen it also in other countries. When you have a certain market segment developing, but there's maybe some risks evolving that you don't really want most of the investors, average investors, to really take necessarily, then you'll take some action. So I would see it in that context.
Interesting, because retail participation here has really been a key driver of India's derivatives surge. But as I mentioned before, of course, the regulator perhaps being forced to step in here because more than 90% of those retail traders reportedly lose money. So you said this is perhaps a good thing for the market more broadly, but do you think it also represents somewhat of an overreach? This derivatives trading is also really important for institutional investors as well.
Yeah, you wouldn't take it completely off, right? You want it to be in the right pockets, those investors that know the risks and are aware of them. And if these risks really materialize, but then also it's, right, in terms of overall maybe assets that are there and stuff, it's maybe a smaller portion. So you have to calibrate it right. And again, not only have we seen earlier steps already in India, but we have also seen it in other markets when these pockets have developed. It's, in my view, quite natural that a regulator steps in and wants to, before anything really more dramatic happens, already takes the first steps.
How much of the improvement in liquidity, the rise, the boom that we've seen in Indian markets has actually been driven by this derivatives trading and investor participation in this space, in your view? Yeah,
that's certainly a key component, right? And that's also why we're seeing these steps happening right now. Right? But again, I have seen it also, during certainly my professional life, right? In many other markets, when you see certain pockets develop, and especially when you have ultimately maybe private investors who are not so familiar with what could happen, right? That you take some action. Again, this is neither for India for the previous steps, nor from other countries' point of view. This is actually a sensible measure to take, that you protect a bit those who are maybe not as familiar with the different market segments as maybe a highly institutional investor.
And Hartmut, I mentioned this before, but of course, institutional investors also rely on this derivatives trading. It's been an important market function for them. Do you think this will ultimately lead to a change in the profile of investor participation here, or maybe even a change in that institutional investor strategy inside India?
I think it paves the way, and of course on the institutional side, but we have many on also hedges and different types of investment strategies that are being employed, right? So those you certainly don't want to undercut completely there either, right? So you just take a path that okay, those who know these market segments, right? Yeah, they can use them in certain boundaries, and others, right, that need a bit more protection, they get a bit more protection. I think that's how I read the steps.
Hartmut, let's unpack your own investment strategy right here, right now as well, because I was looking over some of your notes. You're still quite optimistic on the outlook for India's economy. You see GDP growth accelerating and indeed outpacing much of the world as it has been doing. but how strongly is that going to translate into earnings momentum for some of the key Indian stocks that you're watching, and where's your preference right now?
Yeah, it's interesting. The GDP side certainly helps when it accelerates, and we think it is moving on the way. The real acceleration probably going to come in fiscal 27, so a bit closer to next year then. But in terms of earnings, right? Also, we have to remember, right, the fiscal year 25 is closed, and we had a very low base, right? So in our estimates, my numbers, they tell me close to 6.5%. That's not a lot for an index like the Nifty, for example, right? So that's also something that's easy to ramp up. And if you look at maybe the two largest segments, if you will, right? So one is financials, of course, the banks, right? So we have seen some of the large private banks already starting to show double-digit growth numbers on the earnings side, right? Also in the quarter that is just over, so the June quarter, right? Others, smaller ones, maybe not yet, but we know what's going to happen next, right? So we know that loan growth, for example, is starting to scratch up a bit higher. It's not still early days, right? But it's if I look at towards year end, right? That is one direction. Also looking what RBI, for example, has done in terms of their measures, right? You would expect that to happen. Asset quality is another one, but then the NIMs, right? Also in the Indian market, that's typically an element you need to wait until the RBI is basically done on the rate cut, and then NIMs bottom, and then they come up. So again, for next year, very, very interesting area. And of course, next year is not only a few months away now. You want to be invested now. And the other element we also like is the consumer side. Of course, we just also had some words on GST rather, right? So that here the rates more or less on average, right, that comes a bit down. That's also positive for the consumer side. You see a bit less competition. So these two biggest market sectors alone, I think they should bring us up 27,000, maybe a bit higher even for mid next year.
Okay, so the market has further to run, but Hartmut, this is a market that's also navigating a whole range of headwinds here, of course, not just on the geopolitical front with this increasing divergence from the United States at a political level, but also the most recent US tariffs as well at 50%, plus other macro concerns too. And yet we still see the Sensex trading at 23 times earnings here. It's one of the most stretched markets on earth. Do you think that premium is justified, or is it looking stretched?
It is certainly, if you look historically, right, is it extremely low? No, it's certainly not. But then I'm also thinking, right, so we're coming out of mid-single earnings growth, going into probably at least 2 years. That's how far our forecast horizon is. 2 years of double-digit earnings growth. Now, when you see that change happening, right, typically pretty much in any market, you would see the PE going up first, right, and then later on the actual E, so the earnings side really pulls up a bit, right, and we'll see where that ends. But at this point in time, for that reason, I'm not particularly worried about the PE side. And the other part is also, right, we need to remember, right, all of us who went to university and maybe studied the formulas a bit, right, the valuation side, of course, one element that we also see in there is, say, for example, a 10-year yield, right? We think the India 10-year yield is on the way to break through 6 on the downside and maybe end up about 5.8 or so. That also supports valuation. So it's difficult to make an argument that the valuation should come down. So if then one also follows what we think, i.e. that we are going into 2 years of double-digit earnings growth, then actually the ingredients are all in place.
Okay, we're going to hold you to it. I have to ask as well, just in terms of what else you're looking out for here, you mentioned the RBI call, 3 more RBI cuts this fiscal year, and you've also penciled in a stronger rupee as well, 85 to the dollar at year end. So what underpins those calls?
Yeah, well, the RBI, they want to, right? They want to do their part to re-accelerate the economy, right? So there was a period also where the government, of course, also had to consolidate a bit after COVID, etc. These things are coming to an end. So, and also given how well controlled inflation is these days, right? It gives the RBI room to front load everything a little bit so they can really be sure, yes, it helps the economy. And especially, let's say, right, just in case the highest number of tariffs that could come from the US really comes, right? You also need to balance that off a bit in any case, right? So I think this is also where both the government sit, right? We see that with we saw that with the GST announcement, right? But it's also where RBI sits, where they want to support that part of the economy. So yeah, I wouldn't see too many risks in there. I mean, they're doing their job, and that's why I think the risk factor is not particularly large because they're both acting.
What about the 50% tariff? That's a risk factor, surely.
It certainly is. And I think it is probably not so coincidental, at least my view, by the government. I mean, the GST discussion has been around for a longer time, right? And now it comes right exactly around the time when the US again sort of put statements out that the 50% could hit. So yes, it's probably not too surprising to assume, right? Also from the authority side, from the government side, you want to balance that a little bit. But we have run it through the numbers, and I would make 2 points. Right? One is GDP. So what happens if, let's say, we really get sort of worst case scenario, right? They fully hit and they stay there. Right? So we have given that about 0.6% GDP impact, so which means for, let's say, half a year or so for this year and then fully for next year, we're still ending up very slightly over 6% GDP growth nonetheless. So it's not making GDP growth collapsing. And of course, where we look more at, that's the investment side, so the Nifty. And we have done the historical studies and also like how much export is really driven towards the US out of the Nifty sectors. And I would mention two that are a bit bigger, right? One is, of course, IT services. IT services excluded, right? So you don't see an impact. I would be very surprised if the US aims to include it, because then it's also a bit of an issue for US companies. And the other sector where it's a bit bigger is, of course, the healthcare side, right? So especially generics, but it's also excluded. So you shouldn't see that much of an impact on Nifty earnings. So we have done it through the calculation. Let's say we get a worst case scenario, all these tariffs hit. Even then you could be on a very low end, admittedly, but you could still end in double-digit earnings growth, even for the current fiscal year.
Just before I let you go, when do you expect this GST rationalization to be in place? Will it happen before the end of October? And if so, will it prompt some kind of re-rating for Indian equities and risk?
To some extent, I would say, and when the announcement came, you've already seen a bit of upside there. But it is certainly positive, right? Because we need to remember what has happened. So RBI is stepping in, right, trying to do something for the economy. Government has earlier this year, at least for some part of the income earners, bringing the income tax a bit down, right? And now there's a third measure here on GST. That is a very powerful one, because that really determines, right? You want to buy something now it's cheaper. That really determines your consumer behavior. So slightly positive, I would argue, maybe 0.2, somewhere there about pull up for GDP. Now, of course, you can offset that a little bit on the tariff side, but it helps you a bit balancing things. So also from that point of view, and you asked in terms of timing, yeah, it should be around October. So what you could actually see that some consumers, right, they say, hey, the prices will fall a bit, right? So maybe I wait. So perhaps you don't see absolutely fantastic data the rest of August or September, because people have been waiting, but then they just postpone a purchase, so it will not last very long, maybe 2 months or so, and then they go in, and then there should actually, because prices on average should be a bit lower, that should also be positive for the consumption side. And yes, I mean, we have a lot of consumer companies also that we like, so it chimes in with that picture.
Hartmut, have a great weekend. Really appreciate you coming on today. Thanks for being here. Hartmut Issel there from UBS Global Wealth Management. On the other side of this break, India's social media stars are donning another hat, and nope, it's not acting. We'll give you the details on the other side of this. Stay with us. You're watching Inside India. Welcome back. The rise of social media stars in India has led to creators tapping new income streams. CNBC's Make It reporter Ernestine Su is here to tell us more. Ernestine, you've been taking a deep dive into this sector.
Yes, absolutely. Hi, Dan. Good morning. So India's social media stars are no longer just entertainers. They're also shaping purchase decisions. Actually, many of them are leveraging their existing brands and their followings online to build direct-to-consumer businesses. Now, I'm talking anything from clothing companies to makeup to fitness. You name it, they're doing it. While this trend isn't as new in the West, it has made its way over to India in recent years. In fact, the ecosystem is projected to drive more than $1 trillion in creator influence consumption by 2030. This is according to a recent BCG report. Let's take a closer look. 24-year-old Preeti Sarkar's influencer journey began in India's eastern state of Kolkata with a simple setup, a camera balanced on a bucket. After years of creating videos on skincare and fashion, she dropped the filters and started showing her true self.
But one day I just decided, what if I just take my mask down and I just show people what I actually am? So I just started making videos without makeup, without any filter, just kept my phone in my hand and just started talking. And that became my brand. My identity is very authentic.
Her authenticity resonating with viewers, Preeti now has over 1.6 million followers on Instagram and YouTube. And she's leveraging that fan base to launch Preeti's End, her own clothing brand, where her followers, no matter their height, skin tone, or background, are her models.
We made the brand a community-driven brand. Like 60,000 people reached out to me. I was getting calls. It was crazy.
Preeti's story is part of a larger trend. Many influencers in India are turning into founders, leveraging their existing fan bases to build direct-to-consumer businesses. A recent Boston Consulting Group report shows over 2 million monetized creators now influence more than $350 billion in consumer spending in India.
It's a very recent trend for the influencers. Historically, we've seen successful entrepreneurs in India who have become influencers and not the other way. Brands have also realized that authentic and transparent influencer engagement is quite, it benefits the brand significantly.
This shift comes as India's digital landscape expands rapidly. With over 650 million smartphone users and soaring data usage, more people than ever are online, creating new opportunities for influencers to turn their followers into their customers.
So influencers have grown subsequently, and as their paychecks increase, as their wallet size increases, they are obviously looking at what are the other avenues of monetization beyond just the content on a YouTube or Instagram.
For India's new wave of entrepreneurs, influence isn't just about likes anymore. It's about building brands, communities, and lasting impact. Now, isn't that wonderful? I think it's so great that a little girl today in India can look at Preeti and say, wow, she's only 24 and she's built a clothing brand already. I also want to do that. I think that's what some of these influencers have done so well is they're sharing their journey online. They're bringing people into their lives in such an authentic way. And I think that this really is super valuable when it comes to brands, not just that, but also in building their own brands. Because I think today polish is not as interesting, especially when it comes to the younger generations. They really care about realness. They care about what am I actually putting my money towards? Who am I actually supporting? So I think that these influencers, the ones who are doing really well today, understand that.
Absolutely. I completely agree with you. And it is really inspiring, in fact, to see a young woman doing so well and also really bringing authenticity to her market. Also an interesting case of finding a product market fit because she's done a fabulous job of building that market, finding her audience. Now she's developing a product to try and meet the demand there. So, Ernestine, just expand on this for us a little bit more. When did this trend first start to pick up in popularity and why do you think it's happening now?
Absolutely, Dan. So I think based on conversations I've had with experts, this trend really picked up in the last 2 years or so, and that's due to a few different factors. For one, India's digital landscape has expanded rapidly. Smartphones and data are just so much more affordable and accessible today. And as a result, data consumption has skyrocketed. In addition to that, I think incomes have also risen in India. And overall, a recent BCG report shows that data usage in India has grown from about 12 gigabytes in a month in the 2020 fiscal year to about 27 gigabytes in a month in the 2024 fiscal year. In addition to that, I think that COVID has given a big boost to the influencer marketing industry in India. Everyone was on their phones during the pandemic. That was really the only way to communicate. And of course, this has just come by way of supply and demand. With more eyeballs online, influencers are making more money. And of course, with bigger pockets, they're also looking for ways to diversify their income. And what better way to do so than to start their own businesses?
Exactly. I think we can expect much, much more from this space. It's going to be really, really interesting to watch. Ernestine, thank you for bringing us that really inspiring report. That was great to watch. Appreciate it. Up next on the program, Indian jewelers also shining bright as gold prices surge. But could new tariffs tarnish the glow? We'll put that question to Bluestone CFO on the other side of this. Stay with us. Welcome back. You're watching Inside India. Some other stories we're keeping tabs on today. First, China's Foreign Minister Wang Yi meeting with his Pakistani counterpart on Thursday following his visit to India earlier this week. China looking to cooperate in agriculture and mining and wants to upgrade the China-Pakistan economic corridor. Wang Yi emphasizing China's message to uphold multilateralism and resist bullying. He also invited Prime Minister Shehbaz Sharif to attend the upcoming SCO summit in Tianjin, which Indian Prime Minister Narendra Modi is also expected to attend. Meanwhile, India and France have agreed to strengthen their economic ties after a call between Narendra Modi and Emmanuel Macron. It comes amid increased trade tensions, with India facing 50% tariffs from the US that has prompted India to shore up bilateral ties with other countries to cushion the tariff impact. Both leaders also aligning their positions on the war in Ukraine and the conflict in Gaza. And hundreds of people in various parts of India have been killed after flash floods and landslides. The floods were triggered by sudden cloud bursts during the monsoon season. Some areas in the western states of the country have been completely submerged. We are now counting down to the market open in India, and here's how things are shaping up for the Friday session. I flagged for you earlier that Nifty futures have been pointing in positive territory, but we have seen a bit of a pullback here, now down 41 points. In terms of the overall market sentiment and direction across Asia, that would largely follow the trend. The major markets have been pulling lower through the course of the Friday trading day. We're also keeping tabs on India's IPO space this week. The fintech firm PayNearby is gearing up for an IPO next financial year to fund its expansion. The company, which partners with over 1.2 million retailers, to deliver financial services, plans to add 500,000 more in the next 2 years. Its CEO says merchant bankers are now being finalized before filing draft papers. And a new entrant in the markets this week is the jewelry retailer Bluestone, making its debut on the exchanges, listing at over 1% discount to its IPO price. Shares have picked up momentum since, up over 3.35% now. The offer, though, saw a tepid demand and was subscribed 2.7 times overall. Bluestone's debut comes as jewelry firms in India face US tariff risks, an additional 25% levies on India kicking in next week. So let's unpack all of this with Rumit Duggar. He is the CFO at Bluestone, joining us live now. The first reaction here to the market debut. I mentioned, Rumit, we saw Bluestone listing below the issue price. That's despite what was a relatively decent subscription here. Why do you think it was such a muted debut? Good morning to you.
I think the first tick was down percent or so, but I think through the day, I think the stock closed at 5-6%, and I think it's been trading reasonably well. So I think all our IPO shareholders are in the money from the IPO price.
Do you think market sentiment shifted in the days leading up to the IPO as well? And to what extent does the tariff threat, I guess, cast a shadow over the IPO?
So we are not impacted by tariffs at all. Bluestone is a domestic only consumer brand in India. We have zero exposure to any sort of exports. So we're completely focused on the Indian local market. And if you look at our performance, I think for the last 3 years, we've grown at over 51% CAGR. So the demand momentum in India is very, very solid. And India is our only market that we operate in.
What about your suppliers, though? How vulnerable is Bluestone to the tariff changes on raw imported materials, for example? I know there's no tariffs on gold bars, of course, but that doesn't mean there's not necessarily a wider impact on the business.
So look, our raw material is gold, and India, while we operate in both gold and gemstone-studded categories, gold is the predominant raw material, and gold is a globally traded commodity, right? So obviously the supply and price is determined globally, and as you know, that gold has been on a tear. Gold has seen very strong price movement over the last 2 to 3 years, and despite that price movement, we've grown at 50% CAGR. So I think in India, generally, gold moving up reinforces kind of demand, where Indians also look to buy gold jewelry or gold-studded jewelry as a store of value. So gold price performance actually reinforces that belief and continues to drive demand.
Certainly, it has been a tailwind for you. So expand on that for me. What are you seeing right now in terms of consumer demand? What do the hard numbers actually look like?
So, as I mentioned, I think last year we've grown at about, again, 40% YOY. Typically what happens is when there is a sudden price movement, in a quarter where gold moves up by 10, 15, 20%, there is some pause on demand. But then as price levels consolidate, the demand picks up. So I think in general, demand trends have been reasonably strong in India, and we continue to see the same.
Of course, it's quite a crowded competitor landscape domestically as well. So what's your point of difference, and how do you ensure that you can compete on the consumer side, which is also really seeing, I guess, increased options when it comes to the products that you're selling now?
So interestingly, I think we are probably one of the few companies which is an omni-channel jewelry player. If you look at the Indian jewelry market, which has been there for a long time, is largely unorganized. One, two, most of the jewelers in India are brick and mortar big box retailers, while Bluestone is an omni-channel online first brand, where consumers actually come and browse online. And then they can choose to whether they want to make the purchase online or walk into a store, etc. So stores for us act as like the fifth page of the checkout funnel in the classical e-commerce parlance. And that is a big differentiation, because barring us and CaratLane, between us, we are pretty much the only two players who have the omni-channel market share. And if you look at consumer buying behavior is shifting from over-the-counter purchase experience to more browse first and buy later. And in that, Bluestone has more than 25% market share already. And that is one of the big differentiators. And the second one is we operate in jewelry for the wardrobe, and India, as you know, has largely been historically a wedding heavy market, and that is also shifting. So we have multiple tailwinds, which is driving growth for us.
And of course, one key objective of the IPO is to build out working capital. So what's your plan with this dry powder? Where are you going to be investing to continue to grow and scale?
So the opportunity is tremendous, right? The TAM that we are operating in is a $45 billion TAM, which is one of the largest retail categories outside groceries in India, the jewelry category. Our market share is still very small, although we've grown very rapidly. So the intent of this capital raise is to, as we bring out new stores, we have close to 275 plus stores in India already. And as we keep adding new stores, this capital is going to be largely used for inventory in those stores.
What demand are you seeing from the urban areas?
So demand both from urban and rural is pretty strong, because our AOVs are typically much lower than typical classical big box jewelry retailers. Our AOVs are in the range of $500 versus typical AOVs in India in jewelry category for big box are about $2,000 to $2,500. So our jewelry is more affordable, more lightweight, and given how the gold prices are, generally the market is also moving and looking for options in that $500 kind of AOV price point. So the adoption in both urban and tier 1, tier 2 cities that we are present in more than 117 cities today. The demand trends are pretty robust across the board.
Talk to me about expansion plans as well. You were just talking about your objectives with this new capital. Any plans to grow outside of India?
Not yet, Rand. We have our hands full right now. As I said, we are just about $200 million in revenue, while we've grown at 50% CAGR. It's a $45 billion TAM. So we have more than enough to chew on in India. And right now we're just going to be focused locally.
Okay, Rumit, we'll leave it there. Really appreciate the conversation. Thanks again for coming on today. That's Rumit Duggar there from Bluestone.
Thank you. Thank you for having me.
And we are counting down to the market open. Thank you. We're counting down to the market open in Mumbai. We're going to bring you across what we're seeing on equities on the other side of this. Stay with us. But welcome back to the program. Well, Indian markets are in the pre-open right now. You can see here the Nifty 50 down 0.08%. Dollar rupee at 87.31 right now as well. Let's take a look at some of the movers in the Indian markets today. The leading tech firm Wipro plans to buy the digital transformation solutions unit of the US-based audio products maker Harman for $375 million. That deal expected to be completed by the end of this year, and will see over 5,600 DTS employees globally transitioning to Wipro upon completion. According to the business, the unit's acquisition marks a pivotal step in their ambition to bring end-to-end AI-powered engineering services to their clients, while Harman has said that the sale will allow them to sharpen their focus on its core automotive, electronics and audio business. Staying in tech, and the IT services provider Kyndryl unveiled its latest plans to invest over $2 billion in India over the next 3 years. The plan includes establishing an AI innovation lab in Bengaluru, developing IT talent and supporting digital training for citizens. Kyndryl, which was spun out of IBM, has been benefiting from higher demand for its offerings due to its push into AI. And a quick check on shares of Nazara Tech as well. The reaction here coming after India's parliament cleared a bill banning online games played with money. The bill, which says no one can offer or promote such games, will likely become a law soon. The industry was expected to be worth over $3.5 billion by 2029. But now the new bill could deal a big blow to companies like Dream 11, currently valued at nearly $8 billion. A lot of the companies in the sector are backed by venture capital firms like Peak XV and Tiger Global as well. The government says these games use manipulative, addictive features, and anyone offering them could face up to 3 years in jail. Well, let's unpack the impact with Atul Thakur. He is the Executive Director of Investment Banking at Rathi Advisors. Welcome to the program, Atul. Great to have you here today. So first of all, the government has framed this move as a crackdown on betting and gaming, but what would you say is the ultimate problem that this potential law is now trying to solve?
See, if you look at India as a geography, apart from the state of Goa, where you have casinos on water body, no other states allows casinos also. So online gaming, which was mushrooming over the years, was somewhere or the other going to face this. Last year, there was also significant GST implemented on money games. Now, what the government has observed over the years is that there have been significant ramp up in the middle class going and playing these online games, especially children and adolescents. And fortune of entire family are wiped out because of that. There have been situations of suicides also in online money games because they have become addictive. So that's one of the social problems. On the other side, the issue that the government started seeing is that these portals were used because these portals are largely operated from outside of India. There was limited control and were used for money laundering and financing terror activities. And hence, given the dual issue, government decided to ban all sorts of money games, whether it is by skill or by chance. Having said that, the bill clearly distinguishes between esports, which does not use money and will promote esports. In fact, a detailed law will be established for the same. So money game is now out, esports is in. This will definitely impact a significant number of corporates who are there in the money game business as well as their employees.
Indeed, Atul, and we've already seen an impact on the market, but walk me through what you think the long-term consequences are going to be for the listed players in this space. We've already seen significant share price declines. Do you think this new bill is going to ultimately spell the end of this sector?
So, see, any policy paralysis which is clearly banning and not, regulating it is going to impact the sector overall. On the listed side, we had only one player, which is Nazara, and that too was not generating significant revenue from money game. They were an investor in one of the money game platforms to the extent of $122 million, and they have decided mostly to either write it down their investment or to provision for this based on whatever their auditors will advise. But on the unlisted side, there were many players. In fact, investment by the PEVC funds in this segment was north of $2 billion. And there was a significant advertisement spend, sponsorships, which all these platforms used to do. Especially in the IPL and the international play for the Indian cricket team was sponsored by Team 11 and My 11 Circle. So all these will get impacted.
Indeed. And we're not just seeing the impact on businesses operating in this space, in particular, the one listed business that you mentioned, but also within the private equity space and the venture capital space as well. What do you think this is going to mean for deal flow and broader investor activity in this space on the institutional side as well? Are we going to see funds drying up?
Completely drying up. In fact, I'll tell you, it is not going to only impact the direct impact will be seen by these platforms who are operating money games, but there will be a significant indirect impact seen by fintech players who were supporting and providing wallet services or any other financial support to all these platforms. So there will be, a second or indirect level of impact also on some of these investments, which is right now not accounted for. So only time will tell us how much is the impact on all those players.
Indeed. Institutional investors had been paring back some of their exposure as well. So perhaps, Atul, you could also say that the smart money might have actually seen this regulatory shift coming. So that's where we stand on the gaming side. Where is the opportunity, though? Because you also mentioned that, of course, when it comes to things like esports, that perhaps we will not see this ban having so much of an impact. But of course, this doesn't necessarily mean that there is real money that's going to be moving in the esports space. So do you think this means that investor attention now pivots to other areas of the market, like esports, for example?
Yes, investor attention will pivot to other areas of market, especially esports. But mind you, esports is a very broad spectrum. So something like a PUBG will definitely not be advocated. So anything which is violent in nature will not be advocated. In fact, the bill clearly mentions that anything which is related to India's culture or anything which enhances the skill sets and sporting activity will be, encouraged. So you have to be very mindful as to what games or what companies you are supporting. And that's going to be a thin line. So I think investment, whether listed or unlisted, institutional money will pause in this sector for some time to come.
Yeah, so, but at the same time, India has been one of the fastest growing gaming markets. There is still a lot of investor attention in this space, particularly in esports. Atul, if you were deploying capital, where would you be looking specifically right now, if there were opportunities in this space still?
So, see, on the listed side, what we are seeing is that the offline casino market, which is on the listed side, you have Delton, will probably see some benefit out of it, because then it is going to be a location specific casino market and has also got the money games on over there. On the unlisted side, whichever player, as I said, is focusing on non-violent esports, those will be promoted, and if there is a cultural attachment to it, they will benefit from institutional investors.
Can you give me a specific example? You mentioned the casino market. What do you mean by that?
So India, so Delton and Delton is the only listed one, but there are a few others who are unlisted and have casinos in the state of Goa specifically. And I think they will start seeing a lot more footfall. But so that's on the offline side or the listed side. On the esports side, there are quite a few unlisted players. I would not like to give anybody's name because then it would be a biased opinion towards X versus Y.
Fair point. So when you put all of this together, what do you think the ultimate lesson is to be learned here, particularly for investors looking at India's listed space here when it comes to assessing regulatory risk? Because, of course, there are those out there who will say they were caught off guard by this announcement. They've been spending money in this space, particularly in private equity, venture capital, building out these businesses only to have the rug pulled out from underneath them. What does it say about regulatory risk and the government's approach to managing it in India today?
So, Indian government over the years have consistently monitored anything which is in the sin sector, and somewhere or the other, this even the minister has mentioned that online gaming, money gaming is equivalent to drug abuse. So anything which is equivalent to sin sector will always be hammered by the Indian government. So you have to always play in the right side of what the culture or the country is looking at.
Mm-hmm. And of course, if the participants in this space can't do this in India, then it also means that they're probably looking to do this somewhere else. So are there different markets or jurisdictions that could perhaps benefit from this ban that is going to likely take place in India?
So what will happen is that a lot of companies in any case today are registered outside of India. And probably there will be a pickup in these games through VPN networks. And, there will be a lot of illegal activity that will, in fact, increase within the country and will be looked at it from neighboring countries. Like, for example, there are no such bans in other South Asian countries like Sri Lanka or any other country. So there will be an uptick over there.
An uptick in Sri Lanka, possibly. And just finally, Atul, what is the message to foreign investors here that India is trying to send?
Stay away from sin sectors. One example of that is also that GST on some of the other sin sector goods is going to increase, is proposed to increase from 28% to 40%.
Okay, Atul, we'll leave it there. Appreciate your quick take on what is a really interesting story on the ground in India. Thanks again for being here today. Atul Taka from and Rathi Advisors. Okay, one final check on the Asia markets here for you as well. As I mentioned, it's been a mixed day overall. And of course, all eyes are on Jackson Hole as we count down to this highly anticipated speech from the Fed Chair Jay Powell. You can see major markets, including Japan's Nikkei 225 in negative territory, down 0.11%. The TAIEX is among our loss leaders today, down by around 0.4%. But we are seeing decent gains today for the Singapore Straits Times Index, better by 0.4%, and mainland markets in China as well, better by 0.7%. Thanks so much for your company today. That's all we have time for on this edition of Inside India. Keep watching CNBC. Access Middle East is up next.